following is an update and technical analysis on crude oil, West Texas Intermediate futures based upon the hourly interval in which I had mentioned on the 30th of January 2024, we were trading spot price 77.64 a barrel. Would be presented at the end screen at the bottom left corner at the end of this video. And I had made it clear that we were trading upon a major reactionary uptrend line with major reactionary lows really across the entire sphere here in correlation of the 236 fibs retracement and 77.32 price support, called a triple transitioning price support level with the 50 hourly moving average hovering in and down below, where short sellers, bear traders wanted to see a solid red hourly infused candle sell signal break down below for potential backtest and or retest amongst the primary uptrend line and or 236 fibs retracement on a revisit of the 382 fibs retracement and the 7608 price support, which would be the potential neckline of a head and shoulder classic looking top that would be within the beginning stages of construction upon breaking down below this primary reactionary uptrend line, and the 382 fibs retracement, which would need to have been held by long traders and bullish traders really at all costs to revert a ton of stops to go off and or margin calls on a revisit of the 618 fibs retracement and a potential down primary reactionary uptrend line with major reactionary lows across that entire sphere. And here's the update. Where the initial breakdown sell signal transpired, we ended up having a consolidation phase and a snapback counter trend rally straight into the 236 fibs retracement and the 50 hourly moving average, offering the most valuable short trade risk reward short trade setup to the downside. And the entirety of that move was good for a 7.19% crash to the downside, reflecting upon the consolidation of the 50 hourly moving average, only to be rejected impulsively. And once we took out that level with conviction, that transpired into a ton of stops and or margin calls to go off. Once the neckline was really false bear-like trap, whipsaw-like reaction, we had some minimal reactionary highs across that entire sphere, with another additional false-like breakdown, only to be whipsaw-like once again and recovered, back-tested it 3 hours in a row there, and then only to be infused into a harsh, violent sell-off with a ton of stops to go off, ton of volatility came with this consolidation phase, and only to be rejected and or completely cratering to the downside. And now reflecting upon the primary reactionary uptrend line, where you have some minimal profit taking and or short covering transpiring within these green candle snapback rallies that are occurring down at the primary reactionary uptrend line. Where the technical posture of this primary reactionary uptrend line was exceedingly important, the fundamentals ensued where the week it witnessed one of the larger declines in the spot price of oil due to a widespread move away from risk, following the disappointing macroeconomic data and an unexpected increase in crude oil inventories. The official reports revealed a buildup in crude stocks, contrary to the API's draw and market expectations. Cushing stocks experienced their fourth consecutive weekly decline, while distillate stocks saw a significant drop, synchronized with U.S. crude production rebounding after disruptions caused by the winter storm, only leading to what you would call a beautiful, well-defined bear flag continuation pattern with your initial bear flag pull, followed by a flag and consolidation, and that was met with a wave of selling. And zooming you out to the daily interval, we are trading amongst what I continue to hype and harp around was this primary reactionary uptrend line, and looks like we have minimal reaction. Now the reaction was very minimal, which is slightly concerning there, just the velocity of that drop, where your first three initial buy bid pivot points were met with great big rebounds each and every time that inflection point was retested and backtested. Here we had very minimal reaction, short covering to the downside, small minor 0.6% bounce, and this is a very precarious inflection point for long traders and or bullish traders to defend heavily, where a short sellers want to see an additional solid daily infused candle breakdown sell signal below, which would again offer an additional short trade setup to the downside, or if not, in an add-on to your existing position off the short trade setup you caught at the top, which would transpire to a move down to the 70.09 price support with major reactionary highs and lows. That would be the most additional big target that come across for any long traders to defend heavily once again, and short covering should transpire amongst long traders. We have a confirmed bearish crossover in the moving average convergence, so damage is being infused into the technical momentum indicators, with the stochastics crashing below its 85 threshold with confirmed bearish crossovers. We are in a precarious state. With the RSI relative strength index hovering around the 40 threshold range, there is still, make no mistake about it, setting up the potential for more meat on the bone to transpire, and short sellers just salivating at the mouth now for a big breakdown sell signal below this primary reactionary uptrend line. and that would create another cascade of selling of, and or triggering a cascade of stops to go off, in my opinion. And then ultimately undercutting this level would have a retest of the monthly interval's 66.89 price support, and that will come in confluence of the 1 fibs retracement called $67, and then ultimately the biggest line in the sand being the 63.95 monthly price support level that I will zoom out of and give you the much larger picture to the entire technical posture of the crude oil space, where the main pivot points and or buy zones which would be the most valuable long trade setup. Make no mistake about it, in my opinion, this is an aggressive long trade risk reward ratio long trade to the upside. I believe the most valuable long trade setups will be across the 66.89 monthly and 63.95 price support, color coded in red and tan here. I will zoom you out to the much larger picture, and this is going to be what has been the most valuable long trade and or buy zone for 2 years on out here. Since 2021, this has been the biggest buying zone for long traders and or bull traders each and every time it has been revisited for major crude oil rallies to the upside, and that has transpired each and every time we've come to retest and re-challenge these key pivot points. The 63.95 is the ultimate line in the sand, and that will be the biggest key inflection point that we have seen for, call it 2 or 3 years in a row here, where you could make the case for an additional classic head and shoulder looking top with the beginning foundation and construction here on the much larger picture of the monthly time frame. And that, in my opinion, is the ultimate neckline in the 63.95 price support, where a ton of stops would go off, margin calls, and a big flush down to $54.76 a barrel, coming about a major wave of recessionary talk and a drop dead demand in crude oil space. And zooming you out much larger on the bigger picture here is what I would call the 100 smooth moving average, that has been really the most telling sign for technical traders and for long and short sellers. This has been the biggest key inflection point. 100 smooth monthly moving average has been a historical pivot point for years on end now, dating back since the early 90s, where short sellers have caught major crashes down below each and every time it has been retested and or backtested upon, only to be recovered with major 30% rallies, backtesting, hugging in consolidation phase for major disruptions and big trades to the downside, call it multi-month price support and resistance levels, upon recovering it and ultimately exceeding major rallies to the upside, 84%, backtesting it once again, just in love with the 100 monthly moving average, breaking upon it, entering an additional big bull market rally for 535% in gains, only to have a whipsaw-like reaction here in 2008, which was a false bear trap, only to be infused for a big major rally to the upside and 150% in gains, undercutting the 100 smooth moving average. Was allocated with a huge wave sell-off event, which was good for a 61% crash, only to be revisited upon once again here, backtested upon, entering in a 20%, 30% rally, reflected upon that price resistance level, broke down once again. That was your time to get out of your longs. Backtested it once again for short sellers, just eating it up. That has been a major proxy and or tool for short sellers each and every time, which was then followed by the major COVID crash into negative territory for an 86% crash. And here we are, backtesting it once again. We ended up recovering it right into the early stages of 2021, offering a great risk reward long trade setup to the upside, which was netted for 109% in gains for the Powell losing control out of inflation policy. And here we are, backtesting once again, and it is in confluence of these major reactionary support levels, which I consider the ultimate buy zone if and when some of these levels are revisited. Call it a dual transitioning point, with that moving average hovering in down below in confluence of these major price support levels. That is the most key pivotal inflection point long traders need to defend long-term investors at all costs to avert further damage in what you would call the neckline to the head and shoulder classic looking top, to offer in a huge wave and a much larger crash to the downside. Make no mistake about it, some of these technical postures of the momentum indicators are waning momentum. To retesting its zero line thresholds could ultimately mean a potential whipsaw-like reaction for an infused bigger move to come if and when we were to sell off into the 63.95 price support level for a great long trade risk reward ratio to the upside, only infusing nice moving average convergence support for a much larger move to the upside. Your biggest inflection points to watch for the crude oil space: volatility of black gold, as it can fluctuate significantly in either direction. In navigating this, recognize that technical analysis serves as the only beacon of light amid uncertainties.